So here we go. We're going to be dealing today with vetting the lender and also buyer agency compensation from the lender standpoint. And vetting the lender is actually going to be extremely important in the upcoming days because I think what you're going to be finding is as the whole situation with NAR starts rolling out, that there's going to be a wide level of expectations from different lenders. I need to tell you that most lenders are not thinking along these lines right now, and they really think that everything that is happening today is really going to be an issue for just specifically the real estate agents. And so I honestly don't believe that is the case. I really believe that this is going to have to be a team effort in order to be able to pull this off and actually pull forward with this conversation. So we have a big deal coming down the pipe, and everybody needs to be on the same page in order to be able to make this work. So part of what your job is going to be, whether you're on the listing side or on the buyer side, these same principles are going to apply, and these same questions are going to apply regardless of how you do this. It's going to be extremely important. Some of the stuff that I'm going to be sharing is actually shop talk of what happens behind the scenes in the mortgage world. And these are some questions that you're really going to need to be paying attention to as we go into this conversation. So the first thing that is really going to be, this is going to be a listing. This is driven specifically for the listing agent, but buyer's agents, I got to tell you, really need to pay attention to this too, because the biggest challenge that you're going to be facing, whether you're a listing agent or a buyer's agent, is what ends up happening. What ends up happening with this buyer who's coming either to buy the house that you have listed, or the agent who is going to be putting somebody in their car to show them around town and actually get them under contract on a house. How do you know whether these people have truly been pre-approved and that they understand how to handle the compensation question? This is going to be an extremely important question going forward because, as we all know, as of this weekend, we kind of have to be a little bit more forthcoming on how all of this is going to transpire with the buyer brokerage agreement, and also with the how the compensation is going to flow, and make sure that this buyer has the ability to perform. And if they don't have the ability to perform and the seller is not willing to help out, that in essence we have the ability to make them understand that either they're not buying this house or they need to find a different one. So here are the five must ask questions, and there's a couple more that I'm going to be going over in the next couple pages as we go through this. But these are the five most important questions that you really need to be asking as you're vetting the lender, to understand and make sure that this lender is truly and sincerely done their homework to be able to pull this off. And so here's question number one that you need to be asking. Number one, because this is where we get into the differences of what national banks, internet lenders, and other institutions do. Some of these, you don't have to pull credit actually to do a pre-qualification. You have to do stated income. You have to do stated other pieces of the pie that are related to these to setting up a pre-approval. So question number one is, has the lender run credit? And a follow-up question to this, is this credit sufficient for the type of financing that they're trying to achieve? If you're selling a home that has needs of a little bit of love and lipstick, and maybe the home is not going to make it through FHA, but the lender has run credit and they've got a 680 credit score, well, you're going to have to determine whether that's a valid enough in order to be able to get them conventional financing, because it's very likely they're not going to be able to pull this off. So asking the lender if they've run credit, you're not asking anything for any personal data. You're just asking for the most basic information. Have you run credit, and is it sufficient for the type of financing that these people are applying to? Now, question number two actually plays one of the biggest roles, and this is completely shop talk behind the scenes that most of you are not going to be aware of. Question number two is, has the lender run AUS? Now, what AUS stands for is the automated underwriting system. You do not have a loan with Freddie Mac, Fannie Mae, FHA, VA, if you have not run the automated underwriting system and gotten a good reading on it. Now, the automated underwriting system is based off of data points. So I have to be asking all the appropriate questions along the way to make sure that, in essence, that I have an understanding of everything, all the data points, meaning I've asked them about credit, I've asked them about income, I've asked them about assets, I've asked them about timelines on jobs, whether they're self-employed, whether they're hourly, I've done the calculations correctly. All this stuff gets put into the application portal, and then we have to run the automated underwriting system. It literally takes about 45 seconds to run the automated underwriting system once I've gotten all the data points correct. And what happens is that Freddie Mac, Fannie Mae, and FHA read all the data that is in that application, and they spit back out either an approval or what is called a refer or a denial. Those are the three things. It's an approval or refer with caution, which in essence means we're just simply not doing this loan. The real reason why this is important is because the most common loans that we try to get through, the easiest loans to get through, are the approved ones. So the approved eligible, those are the ones that we're really looking for, because with the automated underwriting system, every loan has to go through it in order to be able to get that down. Those are the minimum guidelines that are in that system, in the automated underwriting system. Those are the minimum guidelines that we have to abide by in order to be able to get this loan closed. And it spits them right out. It tells us exactly what we have to underwrite to. So the underwriter is going to review those, and then they're manually going to check those conditions against what it is that is listed in that automated underwriting system, what it spits out in what we call the findings. So have they run the AUS? Now, if you ask somebody this, I'm going to tell you that you're really going to surprise them, because most people outside of the loan industry don't even know what an AUS is. And so, but this is a crucial piece to be asking, because when you ask that, you're not asking for any personal information. You're just asking if the lender has done his due diligence and if he has gotten an acceptable reading that is going to move forward and actually help this home. Question number 3, this is the next big piece that is actually, this is the one that's going to play such an important role going forward, is has a lender verified the income and the assets? Now, there's a couple different ways that we can verify income. Income, most commonly, everybody asks for pay stubs, everybody asks for W-2s. If they're self-employed, they can ask for tax returns. But many times, if you're working for a big company, like let's say L3 Harris, which is a really big contractor in Florida. We've got several people from Florida on this call. Or maybe it's DuPont, which is a big one right here in the Richmond and the Virginia area. We have all sorts of things like that that can actually support it. They have what's called the work number. Now, the work number is so that we're not bugging human resources all the time. They list all the income right on the work number. So all we have to do is log into the work number, pull that information down, and it gives us an exact reading of whether they're paid hourly, whether they're paid salary, whether they've been on the job for a year or 2 years, whether we can, because it's such a big deal if we're dealing with hourly or bonuses and we have to average, or if we're dealing with straight salary, or if they're self-employed. Obviously that takes a big deal, and we have to really step things back there as well. So that's a really big question that you need to be asking, is have they verified enough income and assets? The asset piece of this is a savings. Do they have enough not only for the down payment and the closing costs, but if the seller is unwilling to pay for the compensation, have they covered enough of the compensation for them to actually be able to go out and buy this home without the help of getting a seller concession? That's a really big question. And you're not asking for anything that is beyond the realms of what is necessary, and you're not asking for any personal identifying information here. So this is a completely legitimate question that shouldn't necessarily be a problem for the lender to be able to share with you. So this is a really good question right here. Question number 4 is, do the buyers need to sell or to lease any real estate to qualify? Now, that's a really big one, because what happens if you are in a place where you're trying to sell the home, and then all of a sudden you find out in the fourth quarter, all the way down to the end, that they have a lease that they're not able to get out of, and that the underwriter is hitting them with that $2,000 payment, and that's screwing up their debt to income proportion? Would that be a problem for them being able to move into this house? That's actually a really big question. We have to do that. If we find out that the lease is actually going to be going on for a good period of time afterwards, we have to prove that they have the reserves to be able to pay for the lease as well as pay for the new house. Sometimes that can be a big deal. And if they're trying to sell a piece of property, that's another question that's a big deal as well. And there's two contingencies that I'm actually seeing quite a bit of right now when it comes to buying a house, one of which I'm seeing a first right of refusal, which is the most common way. But the second one that I'm seeing is I'm seeing a contingency based upon the settlement, which what that means is their house may be under contract, but it hasn't settled yet. I've actually got one of those where it's actually supposed to close next week. And the seller is under contract. Everything is in the final places. We had to let the selling listing agent know that this was going on. They were in a situation where they were in a competitive place, and they actually accepted our offer, even though we had a settlement piece that was coming up and it hasn't quite closed. So these are some very important pieces to know because we want to make sure that the seller has every opportunity to understand the risk of the buyer and understand what it is that they can get into. Now, question number 5, and these are the 5 most important questions. Now, there's a bunch of other ones, and I'll go through those in a second, but these are actually pretty important ones right here. The number 5 is, has the lender reviewed the buyer agent agreement or the buyer brokerage agreement? Now, we're actually asking for these buyer brokerage agreements up front as we're starting to get into pre-approvals because we really need to know how to plan for the compensation. We need to make sure that we understand and we pull things together. I'm going to show you some loan examples that I put together here in a little bit that'll actually go through how we reveal these to the buyer so that they have an idea of what it is that their liabilities might be. And this is an extremely important piece that I'm going to tell you that most lenders are not asking for right now because they really do feel like this is a real estate problem. This is not a mortgage problem. And so making sure that they've reviewed this, because the last thing, especially if you're on the listing side and you know that your seller is not paying buyer brokerage agreement, they're not paying for the buyer side compensation, you need to make sure that you have that all set up so that you can get into a point to where you can move forward, or you can choose another loan because you're going to know that this is going to fall apart. Because that question 5 actually plays back into question number 3, which is the verified assets. That's a huge deal. A really huge deal, making sure that we understand what the buyer brokerage is, and then also that we understand what is going on with the situation on the buyer brokerage agreement. Now, I know this can all be really hard, crazy data here, so I'm going to bring up a question right here that just to kind of make the mood a little lighter. This is question number 2. And I think I know my crowd pretty well right here. Oh, I brought the wrong one in, but let me bring this up. This is just a question. If you have your phone on you and you want to take a picture of this, this is just a real quick poll to ask a question and kind of see what the mood is of everybody that's on this call. I'll just keep it up for another couple seconds before I move to the next page. And if you can respond, that'd be great. Otherwise, you don't necessarily have to. But this is there's a fun one coming up on the next one that I'm going to ask. So, all right, 5, 4, 3, 2, 1, going on to the next question. All right. So the next page is after we get done with the 5 must questions that you need to ask, here's another list of items that you probably need to be asking as you're going through the vetting process. This one builds off of question number 1 about the credit score. Does their credit score meet the requirements of the investor or in addition to the agency? Now, this is a really big deal because VA FHA will actually go down. VA actually has no restriction as far as a credit score. FHA you can also do with no credit score. You have to create alternative credit, but you have to be able to establish some form of credit with it, but they don't have a credit score requirement. Now, having said that, the lower the credit, the more risk it presents on the seller on the listing side, and the more likely the listing agents are going to have a challenge with this buyer because it's going to be requiring quite a bit additional documentation and paperwork on the side of the buyer in order to get them into this house. Now, why is that important? Because if you don't know the lender, they may be willing to go down to a 580 credit score, which is possible through FHA and conventional, but that doesn't necessarily mean that it's going to be an easy transaction or that the transaction is going to have a high level of success. Most institutions prefer to start around a 620 credit score because that's where it's a little easier on the AUS or the automated underwriting system. So that's a really key piece to understand, is that even though they can go down to this 580 credit score, How big of a deal is this going to be? Are we going to have a timely closing, or is that going to be a problem? USDA is another one to consider. USDA, we see a lot in rural areas, and the USDA most commonly starts at a 620, and they have compressed ratios at a 620. Once you get up past a 640, that's when credit score is starting to loosen up. There's also some of the bond programs through Florida and also in Virginia, where they have a 620 minimum credit score requirement. And then when you get into Fannie Mae and Freddie Mac, the lower the credit score, the harder it is for them to get into a situation where they can buy a house. In fact, the investors, many times, we call them investors, many people call them banks, they have what are called overlays, and you can see that right here in the questions. Now, what an overlay means is if you run it through an automated underwriting system, you're going to get the base requirement of that system that is going to tell you what the conditions are in order to be able to close that loan. An overlay is when a bank adds additional on top of that because they want either a cleaner buyer, or they want to resolve something that they feel is a higher risk. Sometimes they add overlays because what happens is they get what's called better pricing, which means that they get better interest rates. And so they're trying to sell to the more credit qualified. Now, that's a really big question that you need to be asking, is about the overlays, because sometimes they may make it just fine through the automated underwriting system, but if they haven't paid attention to the overlays can actually kill it. So that's a really big, important question to be asking when you're looking at the requirements from the credit score standpoint. Like, for example, we do have an overlay on anything over a 50% debt to income proportion. And I can kind of understand that, because once you're over 50% debt to income proportion, that means that 50% of your gross income, which we don't all get our gross income, we get our gross income minus taxes, and then we get to use whatever's left over. The gross income, 50% of that is being used directly to debt. So that means that they're really, if they take 20% off the top of that 100, they're really operating their entire lives, including food, on less than 30% of their income. And that can be a really hard stretch for a lot of people to make it past. The next one right here that is a really good question to be asking is, what is the buyer's type of employment? Now, the reason why this is important, I can't tell you how many times I've had to save a loan from somebody who told them that they were employed, but they were getting a 1099. They gave their gross income, they didn't give their net income after taxes. Well, the gross income is fantastic, but that's not the income that we're using when we're actually vetting and we're actually going through the process of getting somebody set up for a pre-approval. But a lot of online institutions, a lot of banks will use the 1099 gross income instead of asking the appropriate questions about the type of income, because that is totally going to lower what it is that they actually do qualify for. I had one guy that got qualified for a $650,000 house because he told them he was making $350,000 a year. And I'm trying to save this loan. $350,000 was the gross income of his self-employment gig. But by the time he got done writing off every paper clip and pen and rubber band in the office, he got down to where he was actually only making about $65,000. And so in essence, that $650,000 house, mathematically, it just didn't work. And so it was actually a hard conversation for me to have, to say, hey, I'd love to help you, but it looks like to me that this person actually pre-approved you incorrectly, and they weren't able to actually pull this off because they hadn't investigated well enough into the buyer's type of employment. Their debt to income proportion is also a big deal. Based off of this, 50% and overlays with stricter lower DTI requirements, sometimes that's a big deal. And that's something certainly worth asking the seller about as well. Right here is the buyer depending on an equity loan or a cash out refinance of another property for funds to purchase. This is an essential conversation to be asking right now, because especially people who are in that middle market buying homes between that $400,000 and $700,000 price point, a lot of them have multiple properties. And maybe